I'm going to move through this quite quickly. There's quite a lot of content to get through, saying I do talk quite quickly, so I'll probably be talking even more quickly today. Just in terms of the topics that we're going to be covering today, let's have a look at those. So most of you will be quite familiar with some of this content, I imagine. For a lot of you, will be very familiar. We're going to say we're going to rattle through. There hopefully will be some time for questions at the end. But if you have got questions, please put that in the Q&A. And if we don't have time to deal with them, we'll deal with those by email later on. So let's get straight into this. So we're going to talk about incorporations first off. So moving properties out of usually a partnership, but sometimes a sole trade. We'll talk about the issues around that in a minute, into a company structure. So what are the issues there when transferring property into a company, or property business, I should say, into a company? So the main tax issues to be thinking about there are capital gains tax and stamp duty land tax. That will probably come as no surprise to most of you. So when we're looking at the start point for each of these, the capital gains tax position, that's based on the market value of the properties as at the date of transfer. So that would be the normal situation, absent any reliefs that apply. We'd be paying capital gains tax based on the market value of the properties at the date of transfer. From an SDLT point of view, that would also be based on the market value of the properties at the date of transfer. But what we've got to think about here is we've got to think about things like the linked transactions rules, the fact that the SDLT surcharge would apply given that the properties are being acquired by a company, although we do have the possibility of applying non-residential rates of SDLT where a buyer is buying 6 or more residential properties in a single transaction. So there are things that we can look at there on SDLT, but nevertheless, what we could be facing here are some substantial tax liabilities if we aren't able to access reliefs that may be available in certain circumstances. So why would someone consider incorporation? Well, hopefully those of you on the webinar today will be aware of some of these reasons. If you're accountants on the webinar today and you've got clients coming to speak to you about some of the challenges they're facing with running their property businesses, you'll be aware, I'm sure, that some of the reasons why those clients might want to look to incorporate. So why might someone incorporate? Well, the first one, I suppose, is not a reason for incorporation, but it's a benefit of incorporation, a potential benefit. So that is that capital gains tax, that the accrued capital gains or the latent capital gains, as we've referred to them, on the properties to date, can be held over into the new shares in the company when issued. So what you're getting there is an uplift in the base cost of properties. So what that means in essence is if you dispose of those properties shortly after incorporation, although we'll talk maybe later about why you might not want to do that, but if you did in theory, or any of those properties shortly after incorporation, you would only pay capital gains tax on the difference between the date, the value at the date that those properties went into the company and the value at the date at which they were sold. So the original gain would essentially be held over into the new shares and would only come into play if those shares were disposed of in any way, shape, or form. Equally, this is another advantage, I suppose, of incorporation rather than a reason to incorporate. But if we are in the right situation, we're going to talk about this in quite a bit more detail shortly. If we are in partnership broadly, then there would be no liability to SDLT where that property business is operated in partnership and then moved over into the company as part of the incorporation. This is subject to some quite sort of detailed anti-avoidance provisions, which again we'll touch on later. The main reasons, though, I suppose, why someone might want to incorporate. So you'll be aware, I'm sure all of you, mortgage interest relief restrictions that were phased in between 2017 and 2021, I believe, over a 4-year period, now fully phased in. Clearly, now we're in 2025. Those have been quite challenging for many landlord clients, where they are no longer able to access higher rate relief on their mortgage interest costs if they are running their business either as a sole trader or in partnership. Whereas if you run your business through a company, you can still claim high rate relief on those mortgage interest costs, which is obviously a huge benefit to lots of people. The other thing to think about is if you don't use the income from your property business to fund your lifestyle, I suppose. So if you don't want access to all of that income and you actually want to have that roll up to reinvest, or you want to use that perhaps for other things, for example, other investments perhaps, or to allocate money towards future generations, then obviously if you're holding property through a company, those rental profits will be subject to corporation tax rather than income tax. So again, obviously lower rates apply there. So that's obviously useful if you don't need the income. There's often also greater flexibility around inheritance tax planning when we're looking at an incorporated property business. So we're seeing more and more clients now coming to speak to us about IHT, actually, and that being one of the main drivers for considering incorporation, the fact that they want to think about now the fact that these properties have often increased in value significantly since they acquired them, and they're now sitting on quite substantial property portfolios with quite a substantial IHT bill possibly pending. So we're going to briefly have a look now at the conditions for incorporation relief. I don't propose to sort of labour on these. So incorporation relief, the relief that applies or can apply in a situation while you are incorporating a business, any business, but in this case a property business, which would mean that potentially there would be no capital gains tax to pay on the transfer of that business into the company. So what are the conditions? The conditions are that it must be a person who is not a company that is making the transfer. The transfers to a company must be of a business as a going concern. It must transfer all of the assets other than cash, and the consideration for that business transfer must be wholly or partly in exchange for shares issued by the company to the person transferring the business. So we'll maybe come on to talk about some of these points in a bit more detail in a minute, but we have seen situations, not with clients of ours, but with clients, or I think it's well documented actually. There are cases now where HMRC has questioned the ability of clients to have claimed incorporation relief on the basis that not all of the assets were transferred, or that the gain wasn't entirely sheltered by the application of incorporation relief, which we'll come on to now on the next slide. So the gain, if the gain is greater than the net asset value of the business, then a CGT charge will arise. So we can only look at claiming incorporation relief in full where the gain is less than the net asset value of the business. So we've got to be really careful about this. So for most property business incorporations, we're looking at the net asset value generally being the market value of the properties, less any debts that apply. So usually mortgages, there could be other loans as well. And we've had a case recently where we're working with a client who had some other debt. It was a personal loan, but it was still a debt nevertheless. So we do tend to find that clients tend to forget other assets. So we're so focused a lot of the time, or clients are on the properties and the mortgages associated with the properties. But what we've got to remember here is that we are transferring a business as a whole, and that's one of the conditions. So we need to really get to the bottom of what the balance sheet of that business looks like. It's actually my last point on this slide. But it's really important to obtain a full balance sheet from the clients or as the accountant for you to provide a full balance sheet to make sure that we've not left anything behind, as we know that one of the conditions is that all of the assets of the business have to be transferred. It also means we can more accurately work out the net asset value of the business, as I say, because just looking at the properties in isolation is not always the full picture. Obviously, it's a great start point, but there may be other assets that the business holds. We've had property businesses that hold a number of vehicles, for example, because they've got 80, 90 properties and they've got maintenance vans out on the road regularly going to these properties to keep them in good order. We've had, say, other loans, other debt within businesses. We've had all sorts of bits and pieces, really. Some businesses with quite substantial computing and technology assets. So really, it's about looking at the business as a whole, as you would any other business, especially, say, for the accountants on this webinar. This is a business. It happens to be a property business, but we need to look at the assets as a whole there. Sometimes we find that when we've done all this and we've looked at the net asset value of the business, including the other assets and liabilities out with the properties, we find ourselves in a position where the gain is greater than the net asset value of the business. And in that situation, we would end up with potentially a capital gains tax charge. What we find then is it's often useful to look at some of the other costs and things that can be deducted from the value of the property in arriving at that capital gain. So things like enhancement expenditure, incidental cost of acquisition, etc. So this is normal capital gains tax rules, but we find that clients, again, tend to focus on the property value, less the original cost, which of course is the very basic part of a capital gains tax calculation. But we also need to think, or can think, about things like enhancement expenditure and incidental cost of acquisition, if that assists in working out the net asset value of the business, and ultimately assists in meaning that there is no capital gains tax charge that might apply. So what are the challenges here around incorporation relief? Well, we've talked about there having to be a business that is transferred to the new company. The challenge here, the main challenge is there is no definition of business in the legislation. So the main case, which I'm sure many of you are familiar with, is this Ramsey case. There are some kind of guidelines, I suppose, for want of a better word, in that case, in terms of what might constitute a business. So some of the things that we'd be asking clients are how many hours a week do they work in the business? We'd be looking at how many properties make up the business and what happens if they use a managing agent and what does that mean? So I imagine now a few of you are thinking, well, what are the answers to the questions? We can either do questions now, we can do them at the end, but let's just give a broad view on this for now. In terms of hours per week, I think it's fairly well documented that 20 hours per week is the number of hours that it's suggested in Ramsey that someone would be wanting to be actively involved in a business in a property business for it to constitute a business. The challenge there sometimes is that we find that clients are involved with the property portfolio, but also have full-time jobs. So we've really got to be able to kind of evidence that and not just come up with a figure, sort of finger in the air figure. You know, if someone is working 40 hours a week, it's possible, of course, that they could also be operating for 20 hours within their property business, but that needs to be tested a little bit, I'd say. In terms of how many properties make up a business, again, there is no rule on this, and that's part of the problem. As a general rule of thumb, you know, if you're looking at single properties, we would say, but everybody's got a different view on this, we would say maybe 5 or 6 properties would seem to be a reasonable number of properties. However, that will very much depend on the type of properties. For example, something like an HMO could have, you could spend significant time just managing one property, for example. So it really is very fact-based. And again, what if I use a managing agent? Well, lots of landlords use managing agents. That doesn't necessarily mean that you don't have a business. Again, it's looking at that on a case-by-case basis. So for those of you that have been in and around these kind of property business incorporations for quite some time, you will remember a point a long time ago, I'd say it's probably 2015, 16, when there was a clearance process, or that you could certainly submit a non-statutory clearance to HMRC for them to give a view on this. That no longer exists and hasn't existed for a long time. So there is no clearance process. It's really a case of making sure that we're happy that there is a business within the spirit of the legislation, although I say it's not defined in the legislation, but within what case law tells us. So where those conditions are satisfied for incorporation relief, I'm talking about now, per previous slide, incorporation relief applies automatically. So there's no need to claim it as such. It is an automatic application of incorporation relief where those conditions are satisfied. You can disclaim it. I'm not going to go into the reasons why you would want to do that here, but you don't have to claim it. But if let's say once those conditions are satisfied, it applies automatically. So we'd always advise that a white space disclosure is included on the client's tax return where they are incorporating a property business to confirm that they are moving that business from usually a partnership situation into a company, and that they would be essentially claiming Section 162 incorporation relief as part of that. Let's now look then at the SDLT position on incorporation. So we've talked a lot about partnerships already, so I'm sure most of you are aware that special rules apply to transfers into and from partnerships. That's Schedule 15 of the Finance Act 2003. And what those mean broadly, it's where the shareholders of the new company, in brackets, or persons connected to them, were also the partners in the partnership. So where there's been no change, I like to think of it as no change in economic entitlement. So if you've got someone that you've got 3 partners that own 33% each of the partnership previously, or had 33% each of the partnership interest. And once the new company is set up, they also own 33% of the shares in that company. There's been no change in sort of the economic entitlement as such. Then the SDLT liability will generally be nil. There's a wonderful piece of legislation called the Sum of Lower Proportions, which is quite complex, but broadly, where this applies, the SDLT liability will be nil. What we've got to think about, and I put in here scary though, is Section 75A, which is the general anti-avoidance provisions for stamp duty land tax, and when those might apply. And I think what we've seen over the last 5 or 6 years, and I'm sure that those of you that have got your eyes on things like LinkedIn and just generally, some of HMRC spotlights and things will be aware that there have been some mass marketing of some of these incorporation, well, I was about to say schemes today, but that's not the point, that they aren't schemes, but of incorporations. And looking at this idea that people are forming partnerships with a view purely to incorporation, and could that be caught by Section 75A? And the answer is it could be, and it might be. And I think what we do here is take a very risk-based approach to 75A, but a very pragmatic and practical approach as well. So it's not to say that if people have formed a partnership, they can't incorporate, and Section 75A would apply. But I think it's taking each case on a case-by-case basis and considering the applications and the merits of that case. So Section 75, it can be quite a scary piece of legislation. And if we really look at the detail of that, and we have, believe you me, it started with a case called Project Blue, and then more recently there's been a sort of first-tier tribunal case, which isn't binding, but called Hanover Leasing, where Hanover Leasing in particular goes so far with its sort of potential or supposed application of Section 75A that it's hard to know where that would stop. And if Hanover Leasing became a binding piece of case law, it would almost sort of seek to catch every piece of planning where there was an SDLT saving, which is hard to imagine because that would catch loads and loads of sort of M&A type transactions, sort of what I refer to as bog standard transactions as well. So it's hard to imagine that would ever really bite. But anyway, that's as is. So as I say, it's a risk-based approach, case by case always. It is relevant. We as advisors always spell out the risk to clients that, in lots of situations there will be a risk. It's how much of a risk there is if clients are incorporating their property businesses. Clearly, where there is an existing partnership, and I'll come on to that in a minute, then there is no risk of 75A applying, because if the partnership already existed and we're incorporating, then the 75A would not come to bite. So this, how long do I wait before incorporating? What I mean by that is if we've got a partnership and we're formalising that by say, signing a partnership deed, or we're starting to file partnership tax returns, but we're pretty confident and comfortable that partnership has always existed, then the question we often get asked is, well, how long do I need to wait after sort of starting to kind of have to register in the partnership with HMRC and filing partnership tax returns before I incorporate? And the answer is, yet again, that is not prescribed in legislation. There is lots and lots of stuff out there that talks about a 3-year rule. I can tell you now that 3 years is not written anywhere in the legislation. It's written in different parts of the Finance Act, but not in relation to this point about incorporation. So 3 years, I think, is a misunderstanding based on another part of the Finance Act. But again, how long people wait, well, who knows really, but I think it's always good to have filed at least a couple of partnership tax returns before thinking about incorporating, is my general rule of thumb. So I think I've already mentioned some of this, but what is all the fuss about Section 75A? Well, so what is it about? Sorry, I should have probably done this sooner. But so where the seller disposed of a chargeable interest to the buyer, I'm not going to define now what a chargeable interest is, but broadly some land or property that is subject to SDLT or could be subject to stamp duty land tax, and where there are a number of transactions or steps involved, and where then the SDLT payable as an end result is less than the amount that would have been payable on a notional transfer from the seller to buyer. So where you kind of ignore those steps, and the SDLT that would have been payable if you'd ignored those steps was higher than it was with the series of steps in place, then this is where we can start to think about, or should be starting to think about, Section 75A. So what that means is the scheme transactions are disregarded, and the SDLT liability is therefore, the effect of that is it's based on the notional transfer, so i.e. the higher amount if we hadn't had a number of steps in place. So in an example of an incorporation, the steps would be, or potentially could be, forming a partnership with a view to incorporation. So that's a series of defined steps which could then be caught by Section 75A potentially, but again, as I say, it's case by case basis. And then what that would mean, of course, is because we're moving from a partnership into a company, there would be no SDLT, theoretically, because of the Schedule 15 Finance Act 2003 provisions. Whereas if we hadn't moved out of a partnership and we'd had let's say we'd held that property jointly and we weren't holding it in partnership, then the SDLT would be payable as set out on, I think, the first or second slide in terms of looking at normal SDLT rules for things like market value, linked transactions, surcharge for buying through a company, etc. So in that situation, what Section 75A would say is that the SDLT that you've paid is lower, i.e. nil in this case, than it should have been, and therefore that's incorrect. And Section 75A is in play, and therefore you would be, or the client would be, assessed to stamp duty land tax based on the amount that should have been payable. So I mentioned earlier, I think I got ahead of myself and started talking about a case called Hanover Leasing. I also mentioned Project Blue. But what these tell us actually, quite, this is the scary part, I suppose, is that although 75A is an anti-avoidance piece of legislation, there doesn't have to be necessarily an anti-avoidance motive. And as I say, the case law around this is developing. There's nothing that I'm aware of in the last, few months to the last, I think, year or so. I can't remember when Hanover was. But basically, if the SDLT is lower than it otherwise would have been, we need to have an eye on Section 75A, is my point. So that's the bit that we need to be mindful of. So what is a partnership then? Because I guess that's the crux of the issue. Well, first thing I would say is, as tax advisors, we are not and should not be giving views on what is a partnership or whether something constitutes a partnership. What we can do is set out the law and guide people, really, I suppose. But what the Partnership Act 1890 says, again, this is a piece of general law, not tax law, is that it's the relationship which exists between persons carrying on a business in common with a view to profit. So I suppose that, coming back to the incorporation relief point just for a minute, if we decide that there is a partnership, i.e., and because of that there is a business, because that's what this clause tells us, then theoretically, because there is a business from the partnership point of view, there should also be a business from the incorporation relief point of view, but that also needs sort of testing and properly looking at. What's important is substance over form, really. I mean, and that's the same with any law. Now, I have got a slight advantage in that I did train as a lawyer, albeit a tax lawyer. So I've had law rammed down my neck for, a good 15 years or so. But the substance of anything is what's important in law. So whilst the law is there to guide us, it's what's actually happening that's important, not what we think we want to dress something up as. However, the form does help. So it's really getting into the nitty-gritty of how are these people working together? What are they doing? What are their roles? Do they think they are operating together in common with a view to profit? Obviously, the form helps. So what we always say to clients is, if we get to the point, or they get to the point, I should say, or with some legal help, they get to the point where they say, actually, we're quite comfortable, we're operating in partnership, then it's helpful to have some of that formalised. I've referred to that before. So things like a partnership deed, making sure that that's in place, partnership bank accounts, using partnership name, obviously making sure we're filing partnership accounts and tax returns. We find that many people, whilst they may well be operating in partnership, still are declaring income on the property pages, for example, or on their individual tax returns. There's no overarching partnership tax return, which then obviously you take your individual partnership share and put that onto your own self-assessment return. So those things are important. Family partnerships, which of course most or a lot of property businesses are particularly challenging. I wouldn't go as far as to saying that there is an assumption that families are holding property jointly, passively jointly, I mean, but that's opposed to operating in partnership. But we do have to sort of almost disprove that, I think. So where you've got husband and wife, let's say, owning some property together, are they really operating in partnership in the truest sense of the word, or are they just holding some property jointly? There have been quite a lot of case law on this, and what the cases look at quite regularly is the fact that in many family situations, one of the partners, I think in one of the kind of more important cases, it was the wife, but it could equally be the husband, didn't really have a clue what was going on with those properties. So whilst we can have the idea of sort of silent partners in life in general, whether you operate in a law firm, whatever, you might have some silent partners, but the idea is that those silent partners would very much want to have a handle on at least the finances of the business, because they are invested in wanting to make that business a success and invested in running that business with a view to profit. So it's hard to imagine, I suppose, that if someone is that turned off from the what's going on with the properties, that they don't have a clue what the income is from those properties. They don't really, I think in some cases didn't really even know how many properties they held jointly with their partner. That is a true partnership in the strictest sense of the word. So that's where we've got to kind of just make sure that there is a partnership in existence. Let's move on. So can I or should I incorporate? I think, well, the answer is it depends. It depends on your client's objective, and it depends on the facts. So I mentioned the dreaded word scheme earlier. Property business incorporation is not a product or scheme, absolutely not. Each case is unique. Yeah, I think I attended a webinar quite recently on this subject, just because, I'd like to keep abreast of these things to work out whether there's anything else that I should be talking to clients about. And I think the chap that gave that webinar said he'd done something like 350 incorporations over the last, I don't know, whatever it was, 15 years or whatever. we as a firm haven't done that many. We've probably done, I don't know, 30 or 40, but the point is I'm quite picky about the clients that I work with in terms of, if we've got lots of clients, let's be honest, who come to us and say, I'm going to incorporate and these are the reasons why. Now, clearly, that's fine. They've got objectives. They know what they want to do. But if I don't feel that's not right, if I feel that's not right for them, I will tell them. We did have a client quite recently who we said we just didn't think. We were able to demonstrate actually financially that incorporation was not the right route for him. Unfortunately, what he'd done is he'd attended quite a lot of these landlord forums, gone online himself, and was absolutely adamant that incorporation was the right thing for him, despite having a piece of paper in front of him that showed him financially that it was not going to deliver the tax savings that he thought it was going to deliver. So what I'm quite a fan of at the moment with clients, not in all cases, but is a kind of feasibility study. So to work out whether ultimately, if this is a sort of a financially driven exercise, which let's be honest, a lot of the time it is, it's actually going to deliver the results that the client thinks it's going to deliver. And I don't do that in all cases. Sometimes it's obvious that it will, but is it ever obvious? And when we have had portfolios of sort of 80 or 90 properties, we had one which was a father and son. It's all they did. They didn't have jobs. They just, 80 or 90 properties. They've been doing it for sort of 15 years. It was, everything was right about it, I suppose. So that was a kind of an obvious one, I suppose. But yeah, for most cases where clients have a few properties, especially where they want to continue drawing quite a substantial income. I mean, just generally, again, the accountants on the webinar will know that because of the changes to dividend rates and things, the attraction is not what it once was of kind of incorporating any business or running any business through a company and drawing an income, because you've obviously got the corporation tax and then you've got the income tax on the income you draw, whether it's by salary or dividends. And because we've got a very low dividend allowance now and dividend tax rates have gone up, you just need to kind of look at all those numbers in the round, really, particularly if income is a factor. Let's talk a bit then about IHT planning. I'm conscious I've only got a few minutes left, so I'll try and rattle through. We might be able to go 5 minutes over if people are able to stay on. But so I think the first thing to say again about IHT, it all sounds a bit depressing, this, doesn't it? But there is no IHT magic wand in life in general, but certainly for property investment companies. And that's really because there are limited options for investment companies, because a lot of the reliefs that you'd see applying to, the reliefs that you'd see applying to trading companies don't apply to investment companies. So, for example, there is no gift relief for CGT purposes, there's no business relief for IHT purposes. So there's limited options as to how we can achieve IHT savings tax efficiently when we're coming to talk about investment, property investment companies. So the main things that I'm sure you would have seen in passing or kind of referred to online or in conversations or in kind of forums or events that you've attended are basically turning the property investment company into a family investment company. And a family investment company isn't sort of some, crazy sort of, imaginary, I'd say imaginary, but sort of some kind of a vehicle that's a bit mysterious. It is just a company like any other, and it simply is a company like any other, but whose shareholders are family members. So obviously where you've got these property investment businesses, you often find that those are already run like between husband and wife or between brother and sister or something. So more often than not, you're thinking about bringing in future generations, often children, into that position. Thinking about growth or freezer shares. So, for example, when you've got your business theoretically incorporated, your property business, and you're now running that through a company, or even if you're already running it through a company, you can think about introducing different classes of share, usually called growth shares, which means that any growth in value of those properties beyond that date will accrue outside of your estate for inheritance tax purposes and will normally accrue in favour of children or future generations. So protecting growth in value is important because obviously we've seen what property prices have done over the last 20 years. If that trend continues, then there could be some substantial inheritance tax savings as a result of using a growth share arrangement, for example. In terms of current value, then that's where we're really challenged, if I'm honest. You can use trusts. Since I can remember the date, I think it was at 2016 or 2017, I can remember, but the rules which apply to trusts, all trusts, are that any transfer to a trust is a chargeable lifetime transfer, which means that if it's in excess of the nil rate band, which is 325 individually or 650 jointly, that will be subject to an immediate lifetime charge of 20%. So sometimes there is a balance between creating a lifetime charge versus the charge that might arise on death at 40%, and that does need to be weighed up. But let's just assume for now that a lifetime charge of 20% is not palatable, which it isn't for a lot of people based on the value going into the trust. So what we'd be looking at then is a trust which allows you to transfer up to 650 jointly or 325 individually of the value in the company to the trust, which then would immediately fall outside of your estate for inheritance tax purposes. There is a 7-year tail there, but again, that would go into the trust. So that's quite a powerful thing to do, especially if you start early. So where you've got people that have are in their 40s, dare I say, I mean, lots of people in their 40s don't want to think about inheritance tax, but 40s or 50s, and you've say, hopefully got 30, 40 years ahead of you, maybe more. If you do that every 7 years, and obviously we can start to get some decent value into that trust sheltered from IHT. So it is something that's worth thinking about. There's also sort of this idea of minority discounts. So although on face value you might think, well, I can only transfer 650 in proportionate terms into the trust, because if you are transferring minority interest, that may be worth less than you would expect. So you could actually get slightly more in the way of the number of shares into that trust than you might think initially. So that's something we can do. There is, say, we're not going to go into trust today, but there is a sort of a 10-year test to see whether those trust assets exceed the no-rate band, and there are 10-yearly charges. There's also exit charges when you dissolve the trust or otherwise remove those assets from the trust. So they're not for everybody, but they still have a place. But as I say, there's no magic wand really, so start early. Right, I'm conscious I'm out of time already. Just a couple of next slides. I mean, there's partitioning of property investment companies, which was my next point, and then we've got a last slide on property companies that are based overseas. So why would you do this? So a lot of accidental landlords, I call them accidental landlords, people that have just found themselves with large portfolios, also find themselves in situations where they fall out with their co-owners or partners on divorce, or maybe even if they're not fallen out, but they just want different things. So again, I've got some clients who I've been working with probably for a good 7 or 8 years, who have a substantial property portfolio, but one of them is 60 and one of them is 40. They are not related, they are not family members, they are just business partners in the truest sense of the word, but because of their age differences, they are starting to want different things from their property assets. So it's a way to separate their interests without a demerger, which again, for a lot of you, demerger will be a scary word, particularly accountants in the room. I'm sure it's quite a complex process, can be costly, quite time consuming. So it allows landlord clients or property investors to plan for succession individually or because they've fallen out, but basically to separate their interests. What I'm going to do, I think, given time, is we're going to share these slides afterwards anyway, so I'm just going to literally flash these up on screen. But you'll have the slides, and because I've gone into quite a lot of detail on these slides in terms of the steps, it'll hopefully all be self-explanatory, but just wanted to mention that point there about partitioning of property companies. So I'll just whiz through these quickly. So step 1, inserting a new co, share for share exchange. Step 2, we then reclassify the shares into A's and B's. So one shareholder gets A shares, one gets B's. A shares entitled to the A properties profits and B shares to the B property profits. Obviously, we've got to be able to divide the properties fairly. Step 3, we then transfer the A properties to the new co. And then we've got those sort of starting to be separated. And then step 4, distribution of prop co to the new co and reduction of share capital. And what you end up with is basically the A properties being held by the A shareholder and the B properties being held by the B shareholder. And that can all be done very tax efficiently with usually no tax charges. There are clearances required and things, but that's a way to do that. Number of steps. Last slides then, last couple of slides. So holding UK property through an offshore company, what about that? Is it relevant? I mean, it was all the rage, let's be honest. There were lots of people, again, 10, 15 years ago that were holding property through offshore structures at the time because they had some significant tax benefit. There was some significant tax benefits of doing this. However, most or all actually of those benefits of holding a UK property in an offshore company have now gone. So those companies would now be subject to UK corporation tax, including on gains, and UK inheritance tax. So they're a bit of a non-point for lots of people that are UK resident, long-term UK resident, according to the new legislation, which has replaced the domicile rules. They're not going to provide any benefit really. So, and also we find that banks are often reluctant to lend to offshore companies, a lot of sort of kind of administrative hassle and things. So costly to administer, costly to run. So what can we do about it? So We refer to it as re-domiciling the offshore company. It's not really re-domiciling, that's just the term we use. It's not the right term, it's just the term that we use at ETC. So what we mean by that is we insert in a UK holdco via a share for share exchange. There's that share for share exchange, again, quite common with the property businesses. We obtain a clearance, again, so that's been done for bona fide commercial purposes. And again, there's usually lots of reasons why you would want to do that. So plenty of bona fide commercial purpose reasons for that clearance, like things like the administrative costs and the fact that it provides no value. The property is then transferred intra-group from the offshore company to the new holdco, which are then obviously it's part of the same group. So that can be achieved with no tax consequences due to the group rules, tax on groups rules, and then the overseas company can then be struck off. So that's kind of quite a nice, neat way to do that. So again, it can produce, it's not a significantly it's not a hugely difficult exercise, and it doesn't have to be that costly, but it obviously can produce some substantial long-term savings in terms of not having to administer that offshore structure anymore year on year. Right, gosh, I rattled through that. It is 10:35, that said. So that is the end. There was lots to get through in half an hour. It's a popular topic. I think we had 185 people sign up for this webinar, which is kind of huge by our standards. We normally get about 100. So yes, lots of interest. Just very quickly, next webinar, completely different topic, is 24th of July, tactical use of the tax tribunal and ADR for those that are dealing regularly with tax disputes or may find themselves on the wrong side of HMRC. Worth watching out for that one. So thank you for attending. I think we won't take questions now. I'm ever so sorry, but I don't know if there are any questions in the Q&A. Let me just have a quick look. Yes, there are 8 questions in the Q&A. So we will deal with those. If anybody wants to drop any more questions in now, quickly, please do. Before we sort of close the Zoom off, and we will deal with those questions over email later today. We'll circulate all of the questions and all the answers so everyone's got those along with the slides as well. So thank you very much, and sorry for the quick talk. Thank you very much.